Welcome to Credit and Bankruptcy with Reed Allmand. Reclaim your power for financial independence. And now, your host, Reed Allmand.
Hello, and welcome to another episode of Credit and Bankruptcy. I'm Reed Allmand, and we're here to help you reclaim your power for financial independence. And we're doing our second part of our two-part episode on IRS debt. Part one, we talked about how IRS debt is handled in bankruptcy with our guest, Darrin Mish. And now we're going to shift gears. And in this episode, we're going to cover what are some non-bankruptcy options that you can do yourself to deal with the IRS, and what are some options that a tax professional could help you with. So I want to welcome Darrin Mish, tax attorney from Florida, on the phone today.
Thanks, Reed. Thanks for having me.
Great. Appreciate you taking the time to talk to us. We're going to get into some really interesting things that Darrin is able to do and some of the success stories he's had with people doing offers and compromises and other things related to substantial amounts of tax debt. But first, I want to kind of touch on, what if you have somebody who just has a small amount of tax debt, maybe $15,000, $10,000 or less? What would you advise them to do with the IRS that may be something they could handle on their own?
Yeah, when you're into those more manageable amounts of tax debt, sometimes it doesn't make sense to hire a professional. And there's been really an explosion of non-law firm tax resolution companies out there that will, directly solicit taxpayers on the phone and whatnot to try to get them to retain them for things that maybe they should be able to do themselves. So in your example of a $10,000 tax debt, let's say they just filed their tax return and they owe $10,000 and they're afraid and they don't know what to do. This is a little bit rare for me to give this advice, but what I would do in that circumstance is I would actually call the IRS and I would say, hey, I want to get this worked out. I want to get onto an installment agreement. Typically what the IRS would let you do is run that $10,000 installment agreement out up to 72 months. And so just using rough math without, any interest and penalties, that's a payment of about $150 a month. And I think most people could afford $150 a month. Now let's alter that scenario slightly and say that this person owes $10,000 to the IRS, but they just lost their job. But they don't really want to let it slide with the IRS and they're not sure what to do. In that case, what I think they should do is call the IRS and indicate to them that they have just lost their employment, they have no means of income, and that they want their case to be placed on what's called currently not collectible, or sometimes called hardship status. And in that situation where you indicate and you can demonstrate with documentation to the IRS that you have no source of income or very limited source of income, the IRS really doesn't have a choice. They have to place your account into hardship status. So those are two examples that I can think of. If a taxpayer owes very little money to the IRS that they can handle themselves. Now, I'm going to give you a little tip that I don't often share publicly. If you call the IRS, the toll-free number, at 10 a.m. in the morning, there's a high likelihood you're going to be on hold for hours. And sometimes they even do what's called a courtesy disconnect, which is very Orwellian sounding to me. But what that means is they leave you on hold for about an hour and a half, and then they just hang up on you. So here's my tip. You should call that toll-free number at 8 a.m. Exactly. Straight up, 8 a.m. If you make that call right when the phone lines open for your part of the country, you're going to get through relatively quickly. If you wait for that queue to build during the course of the day, you're going to be on hold for a long time, or you may never actually get through. Now, most really good tax professionals actually have sort of a backdoor way to make those phone calls a lot more expeditiously. But that's what I would say to the taxpayers is go ahead and make that call right at 8 a.m.
I think that's great advice and really important for a couple reasons, because a lot of times if you have that little of IRS debt, it's not going to really be cost effective for you to retain an attorney and pay the fees that they're going to charge to help resolve it. And if you ignore it, then you could be looking at a tax levy, a tax lien, a garnishment, when you could have easily just picked up the phone and called the IRS and maybe go on that uncollectible status or get set up on an installment agreement with a very low payment. So that's going to keep the IRS from proceeding with collection activities. And also, isn't there an added perk in that? Because if they go on uncollectible status or their installment agreement, the statute of limitations keeps running on that tax liability, right?
Yeah, you're jumping ahead here, but absolutely. There's something called the statute, the collection statute of limitations, and what that is, it's a 10-year time clock that starts to tick from the date of the assessment of the tax. Now, in the last episode, I attempted to define what an assessment was. That an assessment is essentially when you file a tax return and there's a balance due. Anytime a balance due liability is created on a tax year, that's an assessment. And you can actually have multiple assessments on a tax year, but that gets kind of complicated. But what the layperson can think of is when they file a tax return with a balance due, there's a 10-year time clock that's ticking, and there's things that can stop it. But that's the general rule, is the IRS only has 10 years to collect that. I wanted to go back for a moment, if you don't mind, Reed, and
Sure.
define some of the terms that you used earlier. And we throw them around because we're lawyers and we think that everybody knows what they mean. But levies and liens are really confusing to most people. And I think part of it is that the words are sort of similar, right? But a lien is a public notice filed in the clerk's office, typically in the county that you reside in, and that lien attaches to your property, real and personal, wherever it may be. Essentially what it is, it's an announcement to the world that you owe this tax debt, okay? And liens are bad, but they're not nearly as bad as a levy. A levy is actually a seizure, and or you use the term garnishment. It can be a wage garnishment. We call it a wage levy in my industry, but they can also be, there can be bank levies, I've heard many stories over the years where the woman goes to the grocery store and she wants to run her debit card to pay for the groceries, and it's declined. And what a terrible feeling that must be. And it's declined because the IRS has actually issued a bank levy, and they are entitled to all of the money in the bank account on the date that that levy notice is received by the bank. It's not continuous. It doesn't go on forever. That's a common misperception. But it is, and a lot of banks actually misinterpret the law as well. But the IRS is entitled to the money that's in the bank on that day, and then they have up to 21 days, the taxpayer does, to dispute that bank levy and try to get that money back. As a practical matter, if you've let your case get to the point where there's bank levy, it's going to be real hard to get that money back. It's not always impossible, but sometimes it is impossible. So I just wanted to define what collection action really means. And that's what we think about as lawyers are the really bad things that can happen to a taxpayer if they don't resolve it one way or the other.
Right. Yeah, the IRS is very scary. I mean, you talk about normal collection activities by creditors, vary by state, whether they can garnish you or not, but nobody has the power that the federal government, IRS department does to get the money, and they can do things that nobody else can do, so you don't want to mess with them. So I appreciate you giving some practical advice to those folks out there who just have a small amount of tax liability and they don't know what to do, and maybe it's not really enough to justify hiring a tax professional. But let's go ahead now and talk about if you do have more than $15,000 or $20,000 of tax debt, all the way up to hundreds of thousands of dollars of tax debt, and they're looking for a solution and they want to reach out to you to retain you, and they've heard about this offer and compromise. Give us more information about what you could potentially do for them.
Okay, so an offer and compromise is essentially a program where the IRS is willing to make a deal with the taxpayer to settle their total liability for less. And it's based upon a relatively simple math equation that goes like this. It's their monthly disposable income times 12 plus assets equals the amount of the offer. So I'll give you this example. Let's say that the taxpayer's monthly disposable income is $100. 100 times 12 is $1,200. And just for the sake of this example, let's assume they have no assets whatsoever. So our offer amount is $1,200. It doesn't necessarily matter how much they owe, except for the exception that I'm about to explain, but they can settle $1 million case in theory for $1,200. I've done it. A lot of people will then ask me after I say that to them, they'll say, "You mean $1,200 a month?" No, I mean $1,200 flat one time. Now there's some catches. If you have an offer accepted, and typically the acceptance time takes somewhere between 6 months and 18 months. So the taxpayer files an offer and compromise, it sits in a queue, Eventually, somebody at the IRS picks it up and starts to work it. We don't get a decision for somewhere between 6 and 18 months. Here's the catch. The taxpayer has 5 months from acceptance of the offer to pay the entire offer amount. And then the two catches are the taxpayer's refunds are forfeited for the following 2 years, and they have to remain in compliance with the IRS for the next 5 years. So the offer program in many respects is an alternative to bankruptcy. The IRS understands in many cases there's no way the taxpayer is ever going to be able to pay this money back. And so the IRS interest is actually getting the taxpayer back into compliance and making sure they stay in compliance for at least 5 years. So it's like a carrot and a stick approach here. Is they're like, okay, we're going to give you this one-time deal, but you got to get with the program after that. Because what I've seen is that taxpayers will get outside of the system, either working under the table or just not filing, and they'll stay out of the system typically for somewhere between 5 and 10 years. So the IRS is incentivizing the taxpayers to like get back into the system, contribute, into the treasury and get with the program. So that's pretty much how an offer and compromise works. There's one exception to the calculation that I had indicated, and it's really interesting that we define the collection statute of limitations earlier because the collection statute actually applies to this scenario. And that is, if the taxpayer's monthly disposable income is sufficient to full pay what they owe in taxes within the time left on the statute of limitations, they don't get a deal. So let me give you an example. Let's say there's 100 months left on the statute of limitations, and their their monthly disposable income is $1,000. So 1,000 times the 100 months left is $100,000, but they only owe $87,000 to the IRS. Well, they're not going to get a deal, not going to get an offer through because of the exception. If they paid the $1,000 a month, there's enough money there to full pay the tax liability within the statute of limitations. Now let's flip that on its head. Let's say they owe $100,000 and their monthly disposable is only $100. Well, now we don't have to deal with the exception and they can settle that for $1,200. I know it seems really unfair because it is, but they had to draw a line someplace. And so what does this really mean? It means that the more tax you owe, the better off you are if you're trying to do an offer and compromise. And so that's why I don't want to talk to a lot of people who owe $10,000 because an offer is not an appropriate alternative. Now, I have gotten some offers through on people who owed, $10,000 or $20,000, but quite frankly, because of that exception, it's so difficult to prove they only have $27 a month disposable income or something.
Mm-hmm.
It's just a lot. There's a lot less leeway there to get a deal through.
It's interesting because bankruptcy and offer and compromise are so similar. And, a lot of people who are facing financial issues, we encourage them to call us, to get the analysis because we're not going to put everybody into bankruptcy because sometimes the bankruptcy isn't right. And I'm sure when you talk to tax people, sometimes the non-bankruptcy solutions to deal with your IRS debt are not right and you refer them to bankruptcy. But the thing that I think is very similar is I'll have a potential client call me and say, I make over $100,000 a year. I called one of your competitors and they said, I can't do a Chapter 7. And I say, well, maybe, why don't you go ahead and come in and see us? And then we go through it. And just like you're filling out your offer form looking for disposable income, we're filling out a bankruptcy form looking for disposable income too. And oftentimes you can't just give a yes or no answer because as we dig through that information, there may be additional qualified expenses that reduce that income below $100,000 that we can deduct. There may be some ethical bankruptcy planning we can do. And lo and behold, we get that person in a Chapter 7 and we get them a discharge when the competitor said it couldn't be done. And what I do know, the limited amount I do know about offer and compromises is it's not universal. You really need somebody to look at how those rules are applied because there's some maneuvering, there's some skill and some expertise that can be in that. Can you give me an example of somebody who maybe has come in to see you where that scenario played out?
Yeah, there's so many. but I'm thinking about one, and it just happens to do with bankruptcy. So there's yet another exception, Reed. Can you believe this? So we put this gentleman in. He was a small business owner. We put him into an offer and compromise where we made the offer, and the IRS came back, and the initial analysis was, no, sorry, we're going to reject this offer because our analysis indicates that he can full pay the liability when the life of the statute. And so I would say 9 out of 10 tax practitioners would throw their hands up at that time. Hey, sorry, client, you lost. But I knew about a little exception. And that exception was I had already done a Chapter 7 bankruptcy analysis on that client. And if that client had elected to do the bankruptcy post-offer, he would have received a discharge of essentially all of the tax debt. And so I pulled this rabbit out of the hat and I said, well, okay, I understand your position, but I feel really bad for this client because he's now going to just have to go file Chapter 7, wipe you guys out. And it really makes more sense if you took our very reasonable $20,000 offer on this $100,000 liability. And right then and there, we'll never forget it. We were on the phone. The revenue officer just stops and she goes, hold on a second. And she brings up the Internal Revenue Manual site and she goes, I'm going to go ahead and recommend this for acceptance. Your offer is very reasonable. And we got that offer through. And we didn't even have to appeal. So it not only did we get the offer through, which was awesome for the client, but he didn't even incur the additional expense of having to go to IRS appeals, where I may or may not have won. Exactly. So there's a lot of ins and outs to this thing, and it kind of reminds me of the definition of practice, right? When we get out of law school, we're usually younger and we're full of vigor and energy, and we think we know what we're doing, and we really don't have much of a clue. But over the years, and I've been doing this for over 22 years, you learn more and more and you hone your skills, and that practice actually matters in the long run. I'll never forget, I thought I was a great lawyer at 2 years. I was positive at 5 years. At 10 years, there was no arguing. And now I look back and, okay, so I might have been good, but I certainly wasn't the lawyer that I am now. So
that's right.
There's definitely a difference in who you select for your representation. And I was really interested in your prior example where you were talking about they go to sort of, I'm going to say this, and maybe I shouldn't, but they go to sort of the run-of-the-mill bankruptcy firm. It's just sort of a mill just trying to churn people through the doors, and they just get the easy answer. And that's not what happens at Allmand Law. I've known you for over a decade. That's not what happens at Allmand Law. You're not going to give them the easy, simple answer. You're going to give them the right answer because that's what you're all about.
Right. I appreciate that. Any other kind of tricks of the trade or anything that we should talk about for offer and compromise?
Well, just like you said, there's opportunities to do ethical bankruptcy planning. There's also opportunities to do ethical offer and compromise planning. So very, very few people call me or come through my doors and I look at their situation, I do the analysis, and they're like the perfect offer and compromise. It happens, but it only happens like a couple times a year. One that comes to mind is there was a gentleman that was stocking shelves at Walmart. He didn't have a car. He was essentially homeless. He was making about $8 or $10 an hour, and he rode his bicycle to my office. Perfect offer and compromise. Okay, I didn't have to do any planning, nothing. He's perfect. But in the Tampa Bay area where I live, where I do most of my offers, a family of 4 making $100,000 a year is like on the line. So we're going to have to do a few things potentially to ensure that their monthly disposable income is lower so that ultimately our offer calculation is where we want it to be. Let me define monthly disposable income real quick because I didn't do it earlier. Your monthly disposable income is your gross income minus your business expenses if you're a business owner, minus your personal allowable expenses, and whatever's left over is your monthly disposable income. Now, the key word in that is allowable expenses, because allowable expenses, and you know this, Reed, because you deal with them all day, is allowable expenses. Some of those are actual expenses, but some of them aren't. They're just numbers off a chart that the government has published someplace. And so we really need to take a look at how the actual expenses are today and then potentially spend money in a different way so that we can minimize our monthly disposable income so that we can actually get the taxpayer into an offer in compromise. So I think the odds of your typical taxpayer doing an offer in compromise and getting it through successfully are very slim, except for my guy stocking shelves at Walmart sort of example, right? Where he's living hand to mouth. That's different. But most people in America, I would submit, are not, that have significant tax debt, are not living hand to mouth. And so they really need the benefit of somebody doing some planning for them.
Yeah, that's exactly what I was talking about, because if you have maybe a certain placeholder on the offer and compromise form, let's just use an example here. This is probably not a real example, but you have $200 a month for medical expenses as a placeholder. But really in actual real life for that family, you know, you've got these medical procedures that have to have, you have these prescriptions, you have these doctor visits, and we add it all up, that's $1,000. So if you do the work to get the documentation and you modify the offer and compromise form and you document that, that could change a $1,000 a month potential disposable income offer down to a $50 a month disposable income offer.
Absolutely. Another example comes to mind, and let's say they have, and this is kind of common, the person they've had some hard times and that's where they've racked up the tax liabilities, but now maybe they have $20,000 in the bank. And they want to handle the problem, right? And they think, okay, I'm going to use this $20,000 to resolve this tax debt. Not really, because remember, it's monthly disposable income times 12 plus assets, and that $20,000 is an asset, right? So all we did is increase their offer by $20,000. But sometimes I'll ask people, I'll say, do you have any like deferred dental work that, you know, you need to get done? And occasionally people will say, well, yeah, I need caps or crowns or whatever, and maybe we spend that $20,000 on dental work or medical procedures. Another thing that comes to mind, and I've won more than one case using this, and that is it's so common that they don't have health insurance. Like they have a family of 4 and there's no health insurance at all. And so we say, okay, so right now your monthly disposable income is showing $1,000, but we've got no health insurance. And so maybe the health insurance is $800. They get health insurance, so they get the benefit of the health insurance, and they reduce their monthly disposable income to $200 instead of $1,000, and then we can actually ultimately get an offer in compromise. Now, this is sort of interesting too. I've had 2 cases throughout the years where I encouraged the people to get health insurance for purposes of an offer in compromise, and then they came down with a debilitating illness that would have killed them, but for the fact that they got health insurance, and their lives were ultimately saved. So that always gives me goosebumps when I think about that, because I feel like that was divine providence that they.
Yeah, that's a good point, because if you know they'd gone to one of these 800 tax places where they're just kind of pushing paper around, they may just go off the budget the client gives them. But and then they're talking about now having no insurance, and they're having to pay a much higher offer if they're doing that on installment payment to pay off that offer, and now they have a debilitating illness. And so I think that's why, I keep on saying this, but if you are going to be dealing with any kind of large tax liability and you're wanting to work it out, you really need somebody, and a tax attorney, who is going to take your best interest at heart and give you real advice and not just run through the numbers on what they look like first time around.
And one thing that's really important to me is at my firm, I really try to develop a relationship with the client and try to figure out what the client's ultimate goal is, what they consider a win, I guess.
Yeah.
And so I'll go through holistically and analyze each of these options that we've talked about: offer and compromise, the statute of limitations, currently not collectible, and or an installment agreement. We haven't talked about all that much. But I'll go through those things and then lay out the options for the taxpayer so they can see it. The reason that taxpayers have so much fear and anxiety is because as humans, we fear the unknown. And they don't have enough information to make a decision. So they have this uncertainty, and that uncertainty creates fear and anxiety, and that creates paralysis. So they need to take some action, reach out to some tax lawyer that they trust, and get that information, because what happens is it's kind of like the fog of war. That fog will lift, and then I can lay it out. Well, option number one, you're going to settle for this much, and it's going to cost you this much. Option number two is not as good, but here it is, and that kind of thing. And I don't think that most tax resolution firms treat people like that. I think that it's a one-size-fits-all approach for basically one really high fee, and that's how they handle their business. And I just don't think that, let alone, I don't think it's ethical, but I don't think it's moral to treat people like that.
No, it's not. And I mean, that's not why I got into the legal profession. I know that's not why you got in either. Let's talk a little bit more about installment agreements. And what I've heard before, and correct me if I'm wrong, but sometimes when you do this analysis, you may see that there is one tax year with a very large liability, but if we wait a year or 2 years, that is going to fall off for the statute of limitations. So do you ever put somebody in an installment plan for 2 years and then revisit the offer and compromise when that tax liability is now beyond the statute of limitations?
You can do that, but a more typical scenario would be, let's say taxpayer owes $100,000, but $80,000 is from one particular tax year, and that tax year has 15 months left on the statute of limitations. If there's any possible way, we will stall, kind of like playing four corners in basketball, right? We're just running out the clock, or 3 yards in a cloud of dust in football. You're just trying to run the clock out. So that's what we'll do. And there's even certain types of appeals that we can file where we get protection from collection, but we're running out the clock. And so I've taught, over 100 tax professionals how to do this work, and I teach them this technique. But a lot of people don't know is that you can run the clock out in that scenario. So if we could, in that example, if we could get that $80,000 to expire, well, the installment agreement on a $20,000 tax bill is about $300 a month versus the amount of the installment agreement on $80,000 with 15 months left on the statute is going to be quite high, because in that scenario, the IRS is going to fight tooth and nail to get that $80,000 paid off within the life of the statute of limitations. So, that math, it's going to be a couple $1,000s a month, if not higher, in order at that point. And so what we may do is either do one of these appeals where we're just running out the clock, or we actually might try to get a hardship determination, because we didn't mention this earlier, but while you're in hardship status, which is typically for a year or two at a time, the statute of limitations for collection is continuing to run. And so that can often be a really important distinction as well. So when I am retained by a client, what I do is I get a certain amount of financial information, like you do in a bankruptcy, from the client, and then I get a certain amount of information very low key manner electronically from the government. And once I have those two pieces of the pie, that's when my crystal ball becomes clear and I can lay out the options for the taxpayer at that point in time. Otherwise, there's absolutely no way to do it with any degree of certainty, because you just don't have enough data to make a good decision. You can make educated guesses, but between an educated guess and like rock solid data, I'd rather have the data.
Yeah, because you've got to get all the information about all the tax years, all the statute of limitations, the tolling. We haven't talked about tolling,
right?
Which we want to skip that. But there's so many things that affect this. You got to get the full picture, and then there's strategy involved to determine like what is the best possible outcome and how can we maneuver things throughout this process to get it accomplished. I want to ask you about first-time penalty abatement, because I've come across a situation where someone had a lot of tax liability, and that was a real easy fix. Have you come across the same situation?
Yeah. So my favorite first-time tax payment, first-time penalty abatement case example is, I had a client who had otherwise been a model taxpayer, always filed and paid on time, never had tax liabilities, never paid any penalties, but he had a one-year event that generated a $43,000 tax liability. And so what I told him was, listen, you may be eligible for first-time penalty abatement if I get your transcripts and I see for the preceding 3 years you paid 0 cents and penalties for those preceding years, I can get you automatically, just for asking, I can get this $43,000 penalty abated, eliminated. And so he thought that was a pretty good idea. And so he hired me to do that. And it took one phone call in that case to get that eliminated. Now, the rule used to be if you paid less than $100 in penalty in any given year, that was considered no penalty. Well, they've changed that rule in the last several years. You literally cannot have 1 penny in penalties in the preceding 3 years in order to be considered eligible. But there's many a taxpayer who has called me with a small liability, like in our earlier example of $10,000, and I'll kind of ask those questions. Well, tell me about how this happened, and they'll say, well, this is a one-off kind of situation. I say, okay, here's what I want you to do. I want you to call that toll-free number, and I want you to ask them for first-time penalty abatement. And if you're eligible, they'll go ahead and grant it to you on the spot. It works differently for businesses. For businesses, they will not do it over the phone. You have to file a form. But generally speaking, businesses are eligible as well.
Well, it might be worth sitting on hold with the IRS for all afternoon if it's a $43,000 result for one phone call.
Absolutely. And he was thrilled with the result, obviously, because that's the biggest one we've ever done. But as in our routine practice, when we're getting the transcript information from the IRS in order to do an analysis for a taxpayer, our software that we use to manage our practice actually has the equivalent of a neon sign when the taxpayer is eligible for penalty abatement, and so that we know that we should help them take advantage of that as well.
Okay.
And oftentimes, almost always, that penalty relief alone is more than the entire fee that we charge them.
So I know we've gone through quite a few things so far here on the show. Is there any other topic or area that you want to touch on that you think the people listening here who have tax liability really need to know before they can make an informed decision?
If you have a conversation with a tax resolution company and it sounds way too good to be true, it probably is. It probably is. There's almost no one that can just have a brief conversation with you and say, oh, I know exactly what we're going to do here, and that for this amount of money, we're going to get it done. It requires much more thought and analysis than that. So that's what I would leave people with.
I think that's great advice, because if they're giving you immediate information and they have not pulled your transcripts from the IRS, then really they're guessing, because you may be giving them the most accurate, honest information that you have available. But when we consider the deadlines, the filing dates, if you're off by a day of when something was filed or not filed, it could change the outcome. So the only way to be 100% sure is if you get those transcripts from the IRS, you get the records, and you do the analysis. Otherwise, you're just guessing.
Absolutely.
Yeah. Okay. Well, I want to thank Darrin for coming in. And like we talked about earlier, if you're dealing with financial problems, our goal here through this podcast at Credit and Bankruptcy and through my firm is to help you reclaim your power for financial independence. And what that means is, like Darrin said, getting the information so you can make an informed legal decision. Business owners, big corporations, they always do it. They always call an attorney. They see if bankruptcy is right for them. From our perspective, we're going to pull the information and we're going to see, is bankruptcy a good fit for you? And if you primarily have tax debt that maybe is non-dischargeable and it's not going to get you the best outcome, then we're going to refer you to Darrin to do some non-bankruptcy options to help you deal with that financial information. And so Darrin, if they want to get a hold of you and retain you to help them with their tax matter, how would they do that?
I do represent clients in all 50 states and all 7 continents so far. And our phone number is 888-GET-MISH, or they can visit our website at getirshelp.com.
All right. And Mish is spelled M-I-S-H?
That's G-E-T-M-I-S-H.
Okay, great.
888-G-E-T-M-I-S-H.
All right. And if you want to schedule an appointment with our firm, Allmand Law Firm, we would love to hear from you. You can reach us at 214-265-0123. You can also visit us on our website, allmandlaw.com. That's ALLMANDLAW.com. I want to thank you for joining us for another edition of Credit and Bankruptcy. We enjoyed having you. Hopefully you found this information helpful, and we look forward to seeing you on another episode. Thank you and have a great day.